Good morning. Welcome everyone to join us today for Western Gable Valley Realtors Safer at Home and Learn. Today our guest speaker will be our handsome speaker, Richard Zalite, and he will guiding us how to have a successful loan under COVID-19 and get a successful escrow. And Richard, thank you for coming in today. And you're with PRNG Paramount Resident Mortgage for a long time. We just sent you in. Please start our today's meeting.
Thank you, Pauline. Great introduction. For those of you that do not know me, my name is Richard Zaletta. I've been in the mortgage industry for about 30-some years. I'm honored to do this meeting this morning because as of right now in today's market, I know there's questions out there that are just people are waiting for knowledge as to what's happening. The biggest thing that's going on right now is, yes, we are in a pandemic with COVID-19 that has thrown the lending industry into a little bit of a flux. When it first hit, there was a lot of uncertainty. A lot of programs were cut. There were a lot of guidelines that were being changed. I'm sure you guys have heard the rumors out there of, this and that, and I'm here to kind of tell you a little bit about what's going on. As of today, a lot of the programs are coming back to normal. The guidelines themselves have been written and they've been changed, but they're not as drastic as most people think. The biggest issue right now is the forbearance and the unemployment. When we take an application and we're looking at clients, the biggest thing we want to make sure is their employment. We need to make sure that they're going to be employed and they will maintain employment. Those are some of the biggest precautions that we have right now. We're verifying employment up front. We're verifying employment during the process of the loan, and then we're verifying employment again right before we close the loan. I think we've seen just about as drastic of changes as are going to happen, but in the last couple of weeks, I have seen a lot of the guidelines being eased back. So everybody that feels that lending in today's market is really hard, it really is not. Anybody that has been in the industry back in 2008 during that crash, in 2008, the market crashed, and it crashed because banks were doing bad loans. They were doing loans that they shouldn't have been doing. That's what caused the crash in 2008. In today's market, going up into the shutdown on COVID-19 in March, we were in the greatest economic standard the United States has seen in a long time. The lending industry was the strongest it had ever been. We were doing record numbers. Guidelines were very easy and flexible. Loans were going through very easy. Today does take a little bit of, I hate to say it, but it takes a little bit of knowledge to understand what today's market is. So you really need to deal with a lender and a loan officer that is up to date with current standings. I am constantly looking and reading guidelines and updating myself with what is going on right now. The biggest issue, again, forbearance. When they came out with the forbearance issue, that threw a monkey wrench into everybody because the FHFA, which governs Fannie, Freddie, and Ginnie Mac, they basically stated, if you want a forbearance, just ask, no questions. You don't need to show hardship. That created a lot of uncertainty on the secondary market, and that caused the lenders to start changing guidelines because they weren't sure of where the loans were going to be able to be guaranteed and insured. So when the loans are sold, naturally they're sold to Fannie, Freddie, or Ginnie Mac. That's the majority. But you also have non-banks that are selling loans on the secondary market. And that's the biggest problem, is the non-banks do about 55% of the lending on the mortgage side. So that uncertainty as to whether or not these loans were going to be secured or whether the servicer was going to have to just front the money and keep that loan on their books and not get any money coming in was causing a lot of the confusion. Well, a lot of that has been eased where the FHFA and Mike Caballero has stated, okay, we will only make you responsible for the first 4 months of the forbearance. After that, we will guarantee the loan and we will pay you what you need to be paid. So that eased up a lot of the standards. Now, I will tell you right now, most jumbo loans on the market today are very, very difficult. There's not a lot of lenders that are doing jumbo loans right now. I fortunately am one of the lenders that we are still doing jumbo loans. There's absolutely probably nobody doing jumbo cash out refinances. That just is a market that is gone. I know that right now there's a lot of fight on the market where the MBS and everybody is trying to fight with the FHFA to allow the insurance to come back on jumbo cash out market, because people need money. People need to get money right now and stabilize the market. That's how we stabilize the economy. The unemployment figure right now, as of today, 35.5 million people are unemployed. That's a lot of people. That is the most since the Great Depression, even more than the Great Depression in the 20s. We're at about a 25% unemployment rate. We will see a recovery. We know that there's a lot of talk and a lot of things going on right now about a recovery and about cures and vaccines and a lot of different things. There's a lot of positive on the horizon. I'm starting to see that on the loan side, where again, guidelines are easing up. It is not as difficult to fund loans as it used to be. I was talking to somebody last night. In fact, I was talking to Pauline, and one of the questions is, do I remove my loan contingency? That is a tough question, because even though we may have the loan approved and then we go to loan docs, if that person loses their job, we're not going to fund the loan. So we try to do our due diligence up front. We try to maintain a communication with our clients to make sure that their employment is secure. Most employment now is secure. There's not a whole lot of more unemployment that can go. I mean, everybody that's pretty much lost their income has lost their income. I don't see too many other businesses going out. I actually see a lot of business coming back with the payroll protection plan in effect. That is securing employment, that is securing salaries. So I think we're going to see where we're going to be able to say, hey, okay, we're good. We know we're going to be okay. Let's go ahead and remove the loan contingency. And I hope sellers, even at this market, and realtors, this is where we need your help. We need you to communicate with sellers. We can't predict what the future is going to hold. If we have a client in escrow and we verified and we're good, just tell them, if something happens, we all got to work. We got to be flexible. But as far as lending, we're good. The only drawback right now that I can see on the lending side is what we call the non-QM market, which was your bank statements, your investor no ratios, the asset depletion loans. They're just about non-existent. Some of them are starting to come back. I just saw today that Angel Oak, which is one of the non-QM lenders, just secured $350 million so they can come back into the market and start doing some non-QMs. The biggest thing with that is they are going to be very, very, very restrictive on that market on the non-QM. Loan to values are going to be cut. Ratios are going to be cut. Reserves are going to be added to it. And on the conventional side, I had heard stories of lenders telling me, well, we need 6 months reserves to do a loan. No, we don't need 6 months reserves. We're doing loans. They're available. And I don't know what else to tell you guys right now, except that the loan business is good. We are in a good market. Home purchases are on the rise, even with this stay in place. But we do see a recovery. We do see where we're going to be coming out of this. Does anybody have any questions at this point? Nobody has any questions? So anyway, On conventional loans, we are still doing loans at a 620 FICO, no reserves. We could still go to 97 on some cases, 95 on others. Mortgage insurance companies are really, getting in with the game. They're insuring loans at a better pace. FHA, we're still down to 620 on FHAs. They're very, very nice loans. VA, it's kind of interesting. First time in history, VA loans outdid FHA loans in the last quarter. So there were more veterans buying homes and obtaining loans. When will the mortgage deferment extend? Until when? Michelle, right now, the mortgage, it's not called deferment, it's called mortgage forbearance. And that's an issue that this can go on forever. And I'm not saying forever, but I mean the discussion. The thing is, they can ask for forbearance right now for 6 months. If they still are in a position where they're not ready and not able to maintain their payments, they can ask for an additional 6 months. So they're looking at 12 months. The problem is, if they go into a forbearance, and this is the big thing I've been talking about on my recordings that I've been posting on Facebook and LinkedIn. If you go into forbearance, it is going to affect your credit. It will affect your credit. Credit reporting agencies are already reporting people in forbearance as not making payments. Well, as a lender, we will pull that credit report and we will see they are not making payments, which in turn will tell me, well, I can't qualify them because they don't have a good payment history. We don't have a 12-month history of payments. So we would have to wait for them to become current for 12 months. So if they're in a 6-month, well, guess what? They got 12 months after that before they can even do a loan. The bad part about that, right now, rates are low, and the prediction is rates will go lower. We are at right now, I can get a 30-year fixed at 2.5%. I have never in my 30-something years seen rates at 2.5%. It's not going to last forever, and the people that are going into forbearance right now, if they do not maintain their payment, it will hurt them, and they're going to miss the boat. Because one, if they try to sell their house, that's fine. They can take the equity. The problem is they're going to have a hard time trying to get a loan because of the way it's going to be reported to the credit agencies. The banks themselves, they're not telling the clients that it's going to affect their credit. So when they call and ask for a forbearance, sure, the banks will say, sure, we'll give you a 6-month forbearance. You don't have to make payment. The other issue is, well, what's going to happen at the end of the 6 months? Some banks are stating you're going to have to pay all 6 months at once, one lump sum. Some are saying, okay, we will defer some payments out for a year, or we're going to add it to your mortgage payment for 12 months to catch you up. Now, some are also stating we may just add it to the end of the loan. That would be the best case scenario if it's added to the end of the loan, because it's not going to increase the payment or make these people come up with $20-some thousand at the end of 6 months if that's where they go. So I've actually, and this is something that when I heard this, and I want to say I heard this about a month ago, where I heard realtors were advertising, buy a house now, don't make a payment for 12 months. I can't believe that realtors would do that, because you're not being ethical and you're actually hurting your buyers. Because you can buy the house, we will verify, we're going to ask, and that's one of the things we ask, are you thinking of going into a forbearance? Client says, no, we're good, but guess what? Now they may have committed fraud because the loan funds and then they go into forbearance. That is where the secondary market was scared, because there was no proof. People could just call and say, I want to go into forbearance. First payment, they don't have to make it. But then that hurts us as lenders and as servicers, because guess what? Now we're stuck for that. We can't get our money back. So we have to foot the bill for as long as they do not make the payment. And we're talking billions of dollars when you're talking how many mortgages are funded every month. So we just need to be a little more diligent. We need to educate our clients, just like I educate my clients. Please don't go into forbearance if you do not need to. Trust me, I do know that there are people out there that do need it. They do need it. They're not working. Their income is not there. the unemployment or whatever benefit they're getting can't cover the mortgage payment. That is fine. But people that want to take advantage of the program, they're hurting themselves. They really are hurting themselves. And we need you to educate everybody out there. Take a look at what will happen after they come out of forbearance. They're not going to be able to do anything for 12 months. Stated income, Jessica. Even going into this pandemic that we were in, there really wasn't what we call a true stated income program. There were lookalike programs where they weren't verifying income, mainly for investors. Those, as of right now, do not exist. They're too risky right now. And when you're talking about the non-QM or stated income loans like that, the investors that were doing those loans, they have no guarantee from anybody that those payments will be made. So they don't want to take the risk, and they will not do those loans for right now. I possibly see these non-QM loans coming back probably 6 to 8 months. The situation now, is it better to put the money in your pocket and than pay the bank? No, it is a great time right now to buy. Home prices are going to continue to appreciate. We were, before the pandemic, we were appreciating at a pace of about 8% a month. So that's a great investment. Real estate, no matter what, has always been a great investment. Even during the 2008 collapse, people lost money, but they lost money because they were not being smart with what they were doing. If they held onto their property, well, guess what? They were in a great position. They just had to find the right loan to be able to maintain their payments and keep that property and roll through the issues. All the experts right now are talking about, we are going to recover, and we're going to recover stronger than where we were before we started this whole pandemic issue. So it is a great time. If they have the money right now, please buy properties. You're never going to see rates this low, and you're going to have sellers that are probably more negotiable today, because it still is a seller's market, even though you guys, I know, are limited as to how you can show the properties out there. But you guys are doing a great job. Why wouldn't the banks tell borrowers about credit being affected with the forbearance, especially when they want borrowers to pay? Then that's a great question. When you call in, I know myself, I've called into Wells Fargo trying to verify mortgages on a couple of my clients, and just recently they do have a recording to state, please check with your credit agency, but they're not telling them what it's going to happen, because of the fact is they're just looking at themselves. Big banks, and I'm talking Wells, the big banks, those loans are insured by their own money. Their bank is the money. When you're dealing with servicers that are non-banks, that is money that we need to be recouped by the secondary market or mortgage-backed securities with private investors, so we're not guaranteed. That is why we don't know why they're not warning these people. They should be warning people. This whole thing hit before people knew what was happening. And the forbearance issue, there should have been something going out and saying, if you go into a forbearance, it will affect your credit, and it will affect your credit negatively. That should have been a warning, and I don't know why they didn't do it. I personally think they should have. Unfortunately, they did not. And we're just starting to get the word out right now. I see a lot more people posting videos and posting information about forbearance, because that is a big issue in today's market. So Lynette, I really wish they would have, but unfortunately they did not. If one already obtained forbearance and didn't pay for a month already, what do it do to them and cancel the forbearance? Being a little bit, it's going to help them, because they're going to show a forbearance with missing one payment. So now they're only going to be 12 months out instead of maybe 18 months out. So it's not going to hurt them as drastically as if they went 6 months. But if they did miss one monthly payment, some banks may overlook that. I'm not saying all banks will. Some banks may overlook that with a letter of explanation, and a very strong letter of explanation as to why they missed the one payment and then came back and started making payments again. That is going to be a call that will be done case by case by lenders if they missed one payment. To give an example, I closed a loan with a client. They're in a refinance. I'm lowering their payment to a 20-year fix. I asked them, are you in forbearance? No. We asked again, no. Guess what? Yes, they were. On 2 of their properties, they had entered into a forbearance. Then they said, oh, well, Richard, we did that because we kind of panicked in March, but we never missed a payment. Well, that created a whole new ballgame where now I had to start verifying the mortgages that they currently had that they entered into forbearance. I had to verify that their forbearance has been canceled. I had to get a payment history from their bank, and it was just a lot more questions than what there should have been if they never would have entered in the forbearance because they made their payments. So that is a good question, and it's going to be a case by case if they've only missed 1 payment. Will appraisal criteria be more stringent when banks realize the current distressed economic climate to assess at a lower value? No, the appraisal criteria is going to be the same. It's going to be based on comparables out there. They're going to look at what is being sold. If we start seeing a massive wave of foreclosures, hey, we're going to have values affected. I don't see that happening unless a lot of these people that are in forbearance can't get out. But as far as I see, and everything he said is home prices will stabilize. They're not going to decrease to affect appraised values. I don't think the sellers need to rethink, oh, overvalued housing on sellers, yes. They have to rethink what they're trying to do. If you have a seller that says they want to sell their house for something that's far and above what's on the market, even before this pandemic, it was hard because we had appraisal problems anyway. So sellers need to be more realistic on what is happening in the marketplace today, because they gotta sell it at a fair market value, not an overinflated market value. Unless you got an all cash buyer that's not going to care about an appraised value, then you're going to be okay. No, I don't see cheaper house prices coming. I think we're going to stay pretty level. I think we're going to be where once people start to see that this pandemic is starting to wind down, I think you're going to start seeing more sellers come in the market, and that's going to stabilize the market. It's going to continue to keep home prices steady and also increasing. My best advice in terms of refinancing for homeowners with high equity. I think it's a great time. If you have a homeowner that has equity and they may have, a little higher than normal payment or interest rate, or maybe even mortgage insurance, this is a great time for them to get rid of all that, get a lower rate. Now, there are cash outs available on conforming limits. So if they want to take some cash out, they can do that. The jumbo market is where we're hurting. The conforming level, even high balance, we're able to do cash outs on conforming and high balance loans today. So as long as they got equity, they want to pull that equity and they qualify, this is a great time for them to look at refinancing, pulling that equity and using that equity for whatever they may need, just paying bills to survive. As long as they're still employed and we can qualify them, it's a great time for them to refinance and take advantage of these rates. How will forbearance loan affect the credit? Please kindly repeat. Okay, Michelle. Basically what's going to happen when they are in forbearance, we will pull a credit report and that credit will show loan in forbearance, payments not made, which means they're not making their payments. It's the same as missing payments. It's not going to affect their score. Well, maybe it will. We don't know. We don't know what the credit agencies are going to do with this issue, because you're not missing payments. You're in a forbearance. So it may not affect their scores, but it's going to affect us when we're reading this stating account in forbearance, payments not made. So now we can't verify their mortgage history on that they have not made their payments. That eliminates them and makes them ineligible to refinance. And that's going to go the same for renters. If renters are not making their rent payment, that's going to be the same thing, because we will verify rent on whether they made rent payments in 12 months. And there are renters out there right now that are trying to do the same thing. I don't want to pay my rent. I'm financially struggling. Those are the ones that are going to be hurt because they're not paying their rent. You're welcome, Thomas. So good questions, guys. I really like that. They're very, very good questions. What else do we have from you guys that is looking for answers? Don't be shy, guys. Buyer buy all cash to close escrow, then cash out for high balance purchase during loan escrows. That's a difference. If the buyer buys all cash and then the close of escrow, they want to cash out refi. Is that correct, what you're asking, Sherry? Okay. If they buy all cash and then they want to refinance and get their money back, that is very doable in this market. We have actually a couple of loans that are being done like this, where it was an all cash buy. And in fact, we did one where it was a hard money loan. The person used the hard money to buy the property, and now we're refinancing out of that hard money and actually getting them a little bit of cash because the equity is there. So if they're buying all cash and they want to refinance and get their cash back, very, very doable. And I would advise, if they want to do it, give me a call. Ooh, Mel, that's a good question. When do I see the jumbo market returning? There's a lot of pressure right now on the FHFA to get more security on the jumbo market. I would say my guess would be maybe 3 months, because with the pressure that's being put on them by the MMA, which is the mortgage associations, and all the other people that are talking to Congress and everybody else, they're putting pressure on the FHFA to start reassuring on the jumbo market. I know right now, I think Chase and Wells are no longer doing jumbos at banks right now. I may have a couple of options in a week or two, because I hear that some of these lenders are looking at alternative financing to get these loans done. So the jumbo market, I think, would be coming back in a month or two. Are there any loan programs of stated income from buyer? You mean if they currently bought on a stated income, Michelle? If they currently bought on a stated income, I'd have to look at what did they, is there alternatives? Possibly bank statements. I could look at their bank statements to qualify. I could look at their tax returns. That's another thing. A lot of people, they feel they need to go stated income because, well, I don't show enough income on my tax returns. And that's not always correct. You need somebody that knows how to evaluate the tax returns, because there's a lot of write-offs on a business return that can be added back into the income that helps them to qualify. So that is a tricky question, because I'm not sure why they went stated and how they got that loan. There are alternatives. A client that has high assets, they got a lot of assets in the bank, I can do an asset depletion loan, which asset depletion does not mean I'm taking their assets. It means I'm using their assets to qualify. That's how I get their income. So if you want more on that, please let me know. I can go one-on-one with you on Michelle. I just need a little more information on why they went stated, or what kind of loan they actually did get to refinance out of that into a more stable loan. Oh, interest rate between cash out refi and purchase. Sherry, right now, you're looking at about a 3% difference between purchase and cash out refi. And I'm not saying it's going to be 3 points. It could be less. Let's say I'm at 2.5 cash out refi. You may be closer to about maybe 4. And it's just because, again, they're looking at the risk of them taking cash out and not being able to repay the loan. So those are things that we need to look at one-on-one, but it's not that big of a difference. If a person really needs the cash, they will pay for it now, because guess what? They can cash out now. And in 6 months, I could refinance them again as a non-cash out and lower the rate. So hopefully that'll help you. No, they do not need to pay more points or expenses from a cash out. Cash out refinance and a regular refinance are the same cost. There's no difference in points or expenses. Yes, Mel, you are absolutely right. There's a pent-up demand for jumbos, especially interest rates the way they are. That is why we as the mortgage industry are pressuring the FHFA to start alleviating the restrictions on jumbos. So I will tell you, like I said, if you have somebody that has a jumbo or is looking for a jumbo, let me know. I have some alternatives. I actually have some lenders that are possibly looking at them, I'd say within about a month, but no more than a month. And we'll be able to start doing some more jumbo loans, not cash outs yet, but we'll be able to do jumbo loans and at least facilitate that because that's hurting, especially in our area, the San Gabriel area. You know, we got $1 million homes everywhere, and that's hurting us right now. I hope that helps you, Mel. Four units it's on a purchase is about the same rate. There's a couple of add-ons. It's not that much of a difference. Say from a 2.5, you're probably going to be at a maybe 3, but that's not a big difference when you're talking an investment property, 4 units. Not to mention the amount that I use to qualify, depending if it's an investment property or non-owner or owner-occupied. If it's owner-occupied, I get to use the other units as qualifying income. But rates are close to the same between a single family and 4 units. Not that big of a difference. Hope that helped you, Sherry. Anybody else? Okay, Mimi, bought a house all cash over 5 years. Title was in an S corp. Now title is under a land trust. 2-unit title. Title is a single family house, very stable income. Can this house get a loan? Yes, it can. We could do loans under trust. That is a Fannie Mae guideline. You're allowed to refinance a loan under a trust. I just closed one not too long ago under a trust. We did not have to take it out of a trust. So if you have a loan like that, please let me know. I'd be more than happy to help you refinance that property under your trust. Okay, thank you, Esther. For a trust, if you're going conventional, you're probably looking about 2.5 to 2 3/4 just to do a rate and term refinance. So it's really stable because you're stabilizing, you're actually qualifying them with the income. So you're not really doing anything as far as bank statements or any non-QM. It's a regular qualified mortgage, stable income. They qualify with the income off the home. So you'd be looking at about 2.5 to 2 3/4. I hope that answers your question, Mimi. If someone's unemployment and the loan and forbearance, will it hurt their credit? Yes. Janine, that will definitely hurt their credit. We know that because we've already seen it. We've pulled some credit reports where people are in forbearance and it specifically states loan in forbearance, no payments made. We can't do anything if we're trying to refinance somebody that is not current on their mortgage. We have to have them current on their mortgage for 12 months. That's just a standard guideline. So yes, if they're in unemployment or forbearance, they're gonna have to wait until they're 12 months current on their current loan. Yeah, Mimi, my contact information, I'll put it in the comments if you want, but it is, my email address is Richard Zaleta, Z as in zebra, ALETA 59 @gmail.com. And my phone number is area code 323-974-6323. Contact me anytime. You have a client that is it's due in 7 years, Pauline, stated income. Well, again, this is kind of what Michelle was asking earlier. I need to know why they went stated. What was the reason that they had to go stated? I'd like to look at, do they have assets? I might be able to qualify them with assets. I can probably qualify them with bank statements, which are alternatives to refinance them out of a stated income so-called loan. They may be doing an interest-only loan. Those are things I'd like to talk to you about and look at. But it is going to be something that I need to see a little more information. If they're due in 7 years, when are they due? Are they due now or are they due in 7 years? So again, I could look at their tax returns and possibly qualify them off tax returns, because again, most loan officers and most people, when they look at a self-employment tax return, they don't know what can be added back in to help the client qualify for income. Well, due in 6 months, let's start sending me some information on that, Pauline. I want to see, maybe I can qualify them with their tax returns. I may be able to qualify them with their assets. I may be able to qualify them with bank statement loans, because those are actually coming back. So I could do bank statement loans. So let me know, and I can help you with that. Anybody else? You're very welcome, Pauline. Bank statement loans is where I look at their last 12 to 24 months bank statements. I'll take their deposits and I average out their deposits for either 12 or 24 months, depending which way I go. That will give me their income. So if they're averaging $10,000 a month in deposits, their income is $10,000 a month. If there's a business, if it's a business bank statement, I do have to take out for an expense ratio, usually about 25 to 35%. And that's how I qualify them. It's a personal bank statement. I don't need to take anything out. So whatever they deposit into their personal account over a 12 or 24 month period, average it out. That gives me their income. Very good way to go. I've done quite a few of the bank statement loans. Now, one thing we didn't talk about, what is non-QM? Janine, non-QM is non-qualified mortgage. Those are with private investors that are securitizing these loans, bank statement loans, asset depletion, the old investor where we don't verify, no racial loans, what we call non-QM, non-qualified. Qualified loan is being insured by Fannie, Freddie, Ginnie Mae. We're verifying income, we're verifying assets. It's a qualified loan. Rate and term fee. Do you mean what's the cost on rate and term, David? If you want to know fee, your fees on a rate and term refinance for a bank statement loan basically are about the same as any other refinance. There's no real adding to the fee. You're just going to have your normal costs. Some lenders may charge a point. It's just going to be dependent on the lender, but really not that much of a difference. Yes, you can get a loan after receiving EDDs and PUAs. That has really no effect on us. We're looking at the income, so that would be part of it, because you're guaranteed you still have an income, so that's going to be a big plus. LTV, max LTV right now on a bank statement loan is probably going to be about 70%. DTI, some will go 50. Most of them are probably cutting back to about 45% back. So you're probably at about a 70% loan to value with a 45% back end ratio. They just want to make sure that they're just a little more secured on that. I don't think they'll count the total income on that, Pauline. They will take a percentage of it because it's guaranteed by the government, so they won't use all the income. If they're on EDD for 1 month, we would need them to go back to work and get one paycheck to get them off EDD. because again, we need to make sure that they're being paid. So if they're on EDD currently, we cannot do anything until they're back to work and get one paycheck. These are great questions, guys. We got 60 people on here, and I know you guys have a lot more questions. Please let me know. I'm here to answer your questions. Now's the time. Yeah, EDD short term, then they're rehired back to work is okay for a purchase loan once they've received at least one paycheck, and we can verify that their continued employment is good. That is also part of the payroll protection plan. This is helping a lot of employers because they're guaranteed payroll, so they can hire these people back and keep them working and keep the business open. Exactly, Pauline. Please ask more questions. You guys have to have some more questions. This is a very interesting time. Stating that we won't charge late fees, report additional missed payments. That is correct, Lap. Wells Fargo and all lenders right now, they're by law, actually, they cannot charge late fees. They will not report late fees. They're only going to report that the payments have not been made. That's the only thing. So can credit bureaus still be able to find out on the missed payment? Yes, they're going to verify that with the lender, just like I do. I can call a lender and verify the payment history. As long as I have the borrower's authorization, I have to have their signed authorization and I send it in. But the credit bureaus are doing the same thing. We're verifying with the bank. Are the people making payments? Are they in forbearance? Are they not in forbearance? What's their payment history? That's how it's collected. So when they call or they verify that account, that's when they find out they're in forbearance. They haven't made a payment in 6 months. But again, no late fees. They're not going to charge late fees. David, yes, I could do jumbo loans just on a case by case. I need to see what you're looking at. I do have some alternatives to do jumbo loans. Pricing is not going to be terrible. It's still going to be a good loan. But yes, I can do jumbo loans. Michelle, I'm not sure. What about the interest for the forbearance? They're going to have to make up that principal and interest for whatever payments they missed. So the interest is not going to go away. It is not compounded. It's just that payment gets added, and whether or not they're going to collect it at the end of the forbearance period, defer some payments into the loan, or defer it all the way to the end, that has not been made absolutely clear yet, and that is going to be a case by servicer. I don't think that the government is going to dictate how these lenders are going to make these payments up with these people. Correct, Lap. It won't report additional missed payments to the credit bureau, though. No, I'm sorry. It will show as no payment made, which is basically the same as missed payment. The difference is it's not going to really affect your credit score because you're not missing payments. You're being deferred. When you have a lender or you have a buyer or a borrower that has a mortgage and they miss a payment, that is a drastic hit to their credit scores. With this, it's not really going to affect their scores that much because they're not missing payments. They're in a forbearance. It's a difference. This is a government mandated program. So the credit bureaus won't affect their scores, but it will affect the mortgage rating. The mortgage rating, as far as we're concerned, is what we're looking at along with their score. Anything else, guys? Let me touch base real quick on appraisals, because that's another issue that we're hearing right now. I actually have a client that wants to refinance their property, but they do not want an appraiser coming into their property. That's going to be a touchy situation, because lenders right now, if they are allowing for an exterior inspection only, then we will be okay using an exterior only. If they are asking that they want a full appraisal, that's going to be tough, because the client won't allow them in the property, and that's the same for a purchase. Now, if I run my DU or LP and I get an appraisal waiver, we're good. I don't need an appraisal at all. A couple of my loan officers have run some DUs and they've gotten appraisal waivers, which is fantastic, because that means that we don't need an appraiser. That's going to be a touchy situation going on for the next couple of months. I got to check with appraisal management companies and lenders themselves, and I'm talking the actual lender, to see how are they going to look at this. Where a person has a right. If they don't want a person coming into their home, that is their right. You can't force them. I just got to see if lenders are going to allow exterior inspections only. David, yes, I believe this meeting is being recorded. Sherry, if your wife owns the restaurant and your husband has enough or the husband has enough income to qualify, I do not need the wife's income. Yes, I could do the loan under the LLC, under the husband only, without having to worry about the wife if she's stopped paying rent or she's just not making the income that she used to because of this COVID-19. So if you have that person sharing, you want me to qualify them, please give me a call or send me an email. Look forward to talking to you, Sherry. Anybody else, guys? This has been really good. I'm glad you guys are asking all these questions. I hope I've answered them to the best that you want to hear. It's the truth, and that's the only thing I can do, is tell you the truth and what my knowledge is of today. The industry still today is very steady, with the exception, like I said, of jumbo cash outs. I can still do jumbo loans, rate and term or purchase. There are, like I said, some non-QM lenders coming back on the market, but it is going to be very restricted as far as loan to value and ratios. Anybody else? Anything? Well, I'll tell you what, guys, I hope that you got my email address and my phone number, and I really hope to hear from all you guys. If you have any questions or you need anything that you may need, just give me a call or send me an email. You're very, very welcome, Michelle, and you're very, very welcome, Pauline. And again, I want to thank all of you guys for attending today. Great turnout. I hope to see all you guys again soon, very much in person, not on camera. I do miss you guys, and it's nice that we can at least do this. And again, thank you for allowing me to share, a little bit of my knowledge and a little bit of my time with you guys. Thank you, Bob. Pauline, you're muted.
I'm muted?
Yeah, there you go.
Okay. Okay, Richard, I want to say thank you on behalf of Western Gabriel Valley Realtors, and all the attendees and all the incoming. Some people, they cannot attend, that's 11:30, but they still can hear it again for the recording. And this is a powerful and informative information, as we are right now still need to be safer at home. And it's very meaningful. This is the first one before we call lunch and learn, right?
Yeah,
We don't have lunch today, but we full of energy and knowledge today, right? Do you agree with it?
I'm feeding you with knowledge.
I know, I know. And then we hope sooner or later we can go back to board and we enjoy our lunch together and learn together. But very important message, Thursday morning, you've got to gearing in. What is that? CRMRs will have a clear cooperation policy coming soon status. Very important. We need to follow the rule. Otherwise, we will get fined. Looks like 2,500 will be the fine ticket. So important for Thursday morning. I want everyone to joining 9 o'clock St. Gabriel Board's Emerald breakfast meeting. Another things very exciting is this Friday, our Global Business Council gonna to invite you. We go travel. We will go to Mongolia and we'll present you Mongolia's speaker, and she's a wonderful lady. We signed a MOU with Mongolia last Iraq in Hanoi. So originally we planned to come go visit Mongolia this July. However, we cannot do it, but we want to present you, all of you. Please just sign in and let's make a great event. That will be our first ever global virtual real estate market train series #1. And we're gonna to give you a lot of update for international market information for different country, every country for 1 hour. We invite you, come together. Richard, you need to come together. You need to study for foreigner.
Yeah, I do. I know I do.
When they come in to buy or we go out to buy, we need to bring the money there, right? So we need to know a lot of potential. And then this is a terrific time. We can join it together through the virtual. And I want to thank you again, Richard. You really give us a wonderful time today. And thank you again. And thank you for all of you joining today. And right now our meeting is adjourned. We see you soon for our.
Thanks, guys. I miss you all.
Thank you. Thank you. And we want to thank you, Fang, for the behind the screen to help us doing all the recording, changing the information. Thank you so much. We see you again.
Thanks, guys.
Bye.
Bye. Bye. Go to lunch.